Welcome to Iron Financial. This is the place where we forge stronger portfolios by cutting right through all the market weakness. Today, we are putting Cogent Communications on the anvil. Yeah, the ticker is CCOI. We're going to take a hammer to the fundamentals and really see, does this thing have the structural integrity to hold up, or is it about to just completely fracture under pressure? Let's find out. So the Q4 2025 numbers for Cogent just hit the wire. And, at first glance, it's a real puzzle. There is so much noise in this report, and our job, as always, is to cut through that. We've got to separate the signal from all that static and find the real story under the headlines. A puzzle? That's putting it mildly. To me, it just looks like a flat-out contradiction. I mean, how in the world does a company beat its earnings estimates, but at the same time its sales are actively shrinking? It feels like they're trying to shine up a piece of rust and call it gold. Something here it doesn't add up.
That's exactly it. You hit the nail on the head. See, on one hand, you've got this significant 34% beat on earnings per share. Now, that's the headline that gets the algorithms fired up and buying. It's like a fresh coat of paint they slap on the building to make it look appealing from the street. But on the other hand, a miss on revenue. And not just a miss, revenue actually fell year over year. And that, right there, is the first major crack in the foundation. You have to remember, revenue is the lifeblood of any company. If it's flowing in the wrong direction, that earnings beat is absolutely meaningless.
Right. So to figure out what's really going on here, we need to perform a full structural inspection. We don't just glance at the paint job. No, we go deep. We check the foundation, we inspect the support beams, we test the load-bearing walls. We're going to start with that surface-level contradiction, then we'll drill down into the revenue engine, or lack thereof. After that, we'll look at the 5-year collapse in profitability, the absolutely crushing debt load, and this highly deceptive dividend they're paying. And only then will we render our final verdict. Okay, let's get to work.
Okay, let's dive right into the guts of this thing. The absolute foundation of any company is its ability to grow revenue, period. You just can't have a solid structure without a solid top line. And to be fair, for years, Cogent looked pretty solid. It was building higher, it was expanding its footprint, and you know what? The market rewarded that growth. But every structure has a load limit, and what we need to find out is if that growth was sustainable or if it was just temporary. Now, if you look at the 5-year blueprint, you see something that on the surface looks impressive, 11.4% annualized growth. That's a strong support beam, you'd think. It tells a story of real demand for their services in the past. And this right here, this is the historical picture that a lot of long-term holders are still clinging to. They remember the good old days when this was a reliable growth story. And that kind of history can create a really dangerous sense of comfort. But that's the past, right? That's just looking in the rearview mirror. What does the more recent picture look like? Because from where I'm sitting, that foundation looks like it's starting to seriously buckle. You can't build a future on past glories. It's buckling hard. Over the last 2 years, that impressive growth has slowed to a crawl. We're talking just 1.8%. That is a dramatic, and I mean dramatic, deceleration. Think of it like a powerful engine that was once redlining, and now it's barely even idling. The engine is sputtering. And this is the first major warning sign that the business environment has changed, and this company hasn't been able to adapt. And this latest quarter, this is where the sputtering engine just went completely into reverse. Revenue declined by 4.7% year over year. Let me be clear, that is not a slowdown. That's a contraction. The structure isn't just settling anymore, it's actively shrinking. This is a critical failure. For a company that's supposed to be in a growth industry, a nearly 5% decline in sales is just a catastrophic signal that something is fundamentally broken in their core business. So are they bringing in any new materials to shore this whole thing up? I keep hearing talk of Wavelength and IPv4 revenue. The bulls out there are pointing to these as the future. Is this all just hype, or is there real reinforcement here? I mean, are these new steel I-beams, or are they just flimsy plywood props? That's the entire bull case right there. They have these new, supposedly high-growth segments. Wavelength revenue is up over 73% year over year. Connections are up even more. But, and this is a huge but, these are tiny, tiny segments compared to the core business that's eroding away. The real question is whether these new beams, as strong as they look on a percentage basis, can actually carry the weight of the entire decaying structure. It's like trying to patch a collapsing dam with a few buckets of cement. Yeah, it looks good on paper, but it is not going to hold back the flood.
All right, now let's talk about profitability, because this is where the structure really begins to just fall apart. See, revenue growth is completely useless if it's not profitable. It's just empty calories. It's like building a taller and taller skyscraper without ever reinforcing the lower floors. Sooner or later, the weight becomes way too much.
And right here in these profitability numbers is where we find the real rot in the framework. This slide right here is one of the most damning pieces of evidence I think you will ever see for a public company. For 5 years, revenue grew by over 11% annually. Sounds great, right? But at the very same time, earnings per share, the actual profit that belongs to shareholders, collapsed by an astonishing 99.2% per year. This isn't just a disconnect, it's a complete inversion of what a healthy business should look like. They were getting bigger while systematically destroying value for their owners.
So wait, let me get this straight. They spent more and more money to make less and less profit? They were adding customers and connections, but actually losing money with every single step they took? That's not building a skyscraper, that's digging a pit. And it looks like they just kept digging deeper and faster every single year. That's precisely right. They couldn't pass their rising costs on to customers, and their expense base just ballooned out of control. They became fundamentally less profitable the bigger they got. This is the exact opposite of what you learn in business school. It's not economies of scale. It's a textbook case of diseconomies of scale, where every new dollar of revenue actually costs them more than a dollar to generate. The business model itself is totally flawed.
And here's the crucial point. This wasn't just some accounting trickery or a weird one-time charge. No, their core business operations became massively unprofitable. The operating margin, that tells you how much profit the company makes on a dollar of sales from its main business. So, to see it fall by over 30 points means the core engine of the entire company has seized up and failed. This isn't a cyclical dip, folks. This is a systemic failure in the business model. The entire framework is compromised. Okay, so we've got falling revenue and collapsing profits. This structure is looking really shaky. The facade is cracking, the foundation is completely rotten. So what about the debt? What's holding this thing up? Surely they have a strong balance sheet to weather this kind of storm, right? That's where we find the single most dangerous structural flaw of all. The company isn't being held up by anything. It's being crushed. The balance sheet isn't a safety net. It's the wrecking ball hanging right over the entire operation. Okay, just look at that number. Let that sink in for a second. We're talking over $2.3 billion in total debt. Now, compare that to the company's market capitalization, the value of all its stock, which is just $1.25 billion. Their debt is nearly double the entire value of the company's stock. That is a colossal, almost insurmountable weight. This isn't leverage, folks. This is a death spiral. Every single dollar of operating income they might generate is already spoken for just to pay the interest on this absolute mountain of debt. Now, what's really terrifying about this slide is the velocity of the problem. This isn't some slow-moving issue. In less than 2 years, their net leverage ratio has more than doubled. It went from a, maybe manageable 3.17 to a precarious 7.34. This ratio measures their net debt against their earnings. So for it to explode like this means one simple thing. They are adding debt far faster than they are adding their earnings to support it. The financial stress on the structure is increasing exponentially with each passing quarter. This is completely unsustainable. I'm looking at the balance sheet here, and I see this line item called total stockholders deficit. That just sounds bad. It sounds worse than just having zero equity. What does that actually mean for someone who owns the stock right now? It's every bit as bad as it sounds. It means if Cogent sold every single asset it owns, every server, every mile of fiber, every last office chair, it still would not have enough money to pay off all of its liabilities, including that massive debt pile. The book value for shareholders isn't just zero, it's negative. In an accounting sense, the owners of the company actually owe more than they own. And just look at how quickly this happened. In just 1 year, they went from having $222 million in positive shareholder equity to a $63 million deficit. They incinerated nearly $300 million in book value in just 12 months. Think about that. Shareholders don't just have zero claim on the company's assets anymore. They are technically in a hole. The foundation isn't just cracked, it's gone. The building is basically floating on a sea of red ink. This is just baffling to me. With all this debt, with collapsing profits, with negative shareholder equity, how on earth are they still paying a dividend? It makes absolutely no sense. Is this supposed to be a sign of some hidden strength? Maybe there's some secret cash flow stream we're not seeing that justifies this. It's not strength. It's a giant red flag. In fact, it's one of the most dangerous illusions a company can create. It's like seeing the lights on in a building that's been condemned. It gives you a false sense of security right before the whole thing collapses. Let's take a closer look at this so-called dividend. First thing you need to know, the dividend is not stable. The whole narrative of a reliable, growing dividend is a complete lie. After years of increases, which were designed to lure in income investors, they just slashed the total annual payout by over 22% in 2025. This right here is the company's first real admission that the model is broken. The well is running dry, and they can no longer keep up the facade of being a healthy dividend payer. This cut isn't a whisper, it's a scream for help. Okay, hold on. I see this right on the company's own investor relations website. It says the dividend is a return of capital. That sounds an awful lot like they're just giving me my own money back and calling it a dividend. What's the catch here? Why would they do that? That is exactly what it is. It's a financial sleight of hand. And the catch is the why. The reason they do it is because they have absolutely no other choice.
A real dividend should be a share of the profits. It's your reward as an owner for the company's success. A return of capital, on the other hand, means the company has no profits to share. So they are literally taking money from one pocket, either by taking on more debt or draining their cash reserves and putting it into the shareholder's other pocket, all while calling it a yield. It's a financial illusion. It's designed to keep those income investors from fleeing, but it is not sustainable. They are weakening the company's structure just to pay it.
Okay, we've completed the inspection, we've examined the revenue engine, we've looked at the profitability framework, we've x-rayed the balance sheet foundation, and we've exposed the dividend facade. It is time for the verdict. Is this thing a fixer-upper with good bones that just needs a little cosmetic work, or is it a total teardown?
Look, the bull case here rests on a completely misleading EPS beat, a headline number that means nothing with context, and some hope pinned on a few small growth areas like Wavelength. That's the entire facade. The bear case, however, is built on the cold, hard reality of the numbers you see on the right. Shrinking sales, collapsing profits, a mountain of debt that's nearly twice the company's value, a dangerously high leverage ratio, negative free cash flow of $43 million, a shareholder deficit, and a dividend that was just cut and is now being funded by literally destroying the company. The evidence is simply overwhelming. The foundation is gone.
Our verdict at Iron Financial is crystal clear. This is not a value opportunity. It is a structural trap. The surface might look passable to some, but the foundation is rotten to the core. That EPS beat is nothing but a distraction. The dividend is a mirage, and that debt is a wrecking ball that's just gaining momentum. Approaching this stock is not investing, it's demolition work. And at Iron Financial, we do not stand in buildings that are about to be demolished.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.